Hello and welcome to the essay. Today I'm here with Adrian Day of EuroPac Gold Fund. So Adrian, it's really great to see you again.
And you, Amy. Good to see you last month as well, or earlier
Yes,
this month.
absolutely. We did have a really nice catch up at PDAC in Toronto. And so maybe we could just kick off. If you could tell us a little bit about your role at EuroPac Gold Fund and kind of your approach to investing in the precious metals space.
Right. Well, I'm the portfolio manager for the Euro-Pacific Gold Fund, which is, Peter Schiff is the founder of Euro-Pacific. I'm sure a lot of people will know him, but I manage the fund. Yeah, so the approach, I suppose the approach is to try to get exposure to both. We try to build a foundation of solid, relatively low risk equities that will give you exposure on the upside, such as the major royalty companies, for example. They're low risk, but they're excellent foundation. And then we try to have exposure to pretty much all of the sectors, the major miners, intermediate miners, and also, frankly, the exploration and smaller companies as well, which, as you know, can give you, a lot more upside in a good market.
Absolutely. And I mean, to be honest, gold has really been in the news lately. We've seen continuous record-breaking gold prices this year, and that's all kind of considering the current geopolitical landscape that we seem to be living through. So, can you talk a little bit about how these different forces on the market are kind of impacting pricing and what you might see for the gold space moving forward?
Yeah, well, it's interesting. I mean, obviously, the gold stocks, particularly the major stocks in the US, but well, worldwide, have done very well over the last 12 months, but also just really this year. And I'm just looking at, if I turn my head, I'm looking at a chart here, the XAU, which is the North American, the index of the Philadelphia Gold and Silver Index, which is the major, primarily North American gold and silver miners. That's up 48% in the last 12 months. Now, the smaller companies, both the intermediates, but also particularly the smaller ones and the exploration companies, until very, very recently, like the last couple of months, really have not moved much at all, other than for, there's a particular event, a particular development, but it certainly hasn't been a matter that whole subsector has moved up. And I think part of a reason for all of this, it really goes back to why gold has been moving up for the last 2 years and who's been buying. And then particularly who hasn't been buying, and who hasn't been buying are the North American, the normal North American investors, both retail, but also, small institutions have simply not been buying. And an illustration of that, if I may, if you look at the GDX, which is, the VanEck Gold Miners Index, which is the largest gold mining index in North America, and I would think probably in the world. But we've only had 1 day, they've only reported 1 day this year of net inflows. Now, when you think that gold is at, over 3,000 at these historic high levels, and it's been going up consistently over the last 2 years, it boggles the mind, if that's a technical expression, it boggles the mind that we've only had 1 day of net inflows in the North American index. And the GDXJ, which is the what they call the juniors, it's not really juniors, but the smaller company, that's less than the major miners, you have to go all the way back to August to find a day of net inflows. So to me, what this means is that, and this is a good explanation for why the juniors are not moving, but some of the seniors are. Because if you're a very sophisticated investor and you want exposure to gold stocks, you might buy Barrick or Kinross or Gold Fields, all of these you might buy, but you don't buy Consolidated Moose Pasture. And that's for retail people, and they're just not in this sector. That's going to change, I think. When you see gold at record highs, you see the S&P, wobbling, shall we say? That's a polite way of putting it. And when you see increasing cash flows, everybody focuses on how much costs are going up, but nobody seems to focus on the fact that the gold price is going up a lot more rapidly than costs are going up. So the cash flows, the margins are expanding and the cash flows are just remarkably strong. I think that's going to start gaining attention. It's not on the mass media over here at all. The financial media is not talking about it.
A lot of the conversations that I had at PDAC, people were saying that the juniors in the gold space are quite undervalued at the moment. Do you see that changing?
Well, that begs the question, do I think that they're undervalued?
Mhm.
So I still think the seniors are undervalued. If you look at the stocks like Agnico or Barrick or really all of the XAU, Kinross, whatever, despite the fact that they've gone up by 50% over the past 12 months, and in many cases by more, on a valuation basis, they are still at very, very reasonable valuations and in the lower half, and in many cases in the lowest decile of their long-term historic valuation. So I still think the seniors are undervalued. Now, if you move down the food chain, it depends what we mean by juniors, of course. If we get to the really small companies, the exploration companies, the kind of companies that dominated the exhibit hall at PDAC, not all of them, of course, because Barrick was there and so on, but the kind of companies that dominated, I'm not talking about the PDAC companies anymore, but I think it's true to say that at least half of those companies, well, in my view, they have no business existing as separate companies. But I think if you look at the sort of 3,000 gold mining companies around the world, probably only 25 or 30% of those are what I call real companies. And those companies are indeed very undervalued. There's no question about that. I mean, the others are cheap, but whether they're undervalued is a different question. So yeah, I definitely think that sector is very, very undervalued. And that includes the companies the stocks that have moved up because they've, among that subsector, because they've moved up for good reason. And I think they still have a lot further to go.
And so, I mean, how do you determine what makes kind of a real company or, an investable opportunity for you?
Well, part of it comes to market cap. Now, I'm not afraid of investing in very, very small market caps. That doesn't bother me at all. The problem is, do they have cash? Do they have access to cash? Do they have a way of generating cash without excessive dilution? And so if you look at some of these companies where the shares outstanding have gone up 5 or 10-fold in the last 5 years, and the underlying value of that company has not gone up 5 or 10 times, right? There's nothing wrong with issuing shares and if you in fact do something valuable with that cash. But if you're simply raising money to keep going, and then you're diluting shareholders, and we see that over and over again. So that's one of the things I look at. When companies raise money, how much of that money is going to G&A, particularly salaries, and how much of it is actually going to work? I'll say in the ground, but it doesn't have to be drilling. It can be mapping, it can be geophysics, it can be looking for projects. But how much of that is actually going to furthering the business as opposed to just continuing existence as a public company? Now, let me say there's a lot of very, very energetic people that work their butts off, if I can say that. They work really hard. They've been doing it for 20 years, and they just haven't achieved anything. And one can give them credit for trying, but when you're just too small and you're continually raising money just to keep going, to pay the accountants, to pay the filing fees, to pay the overhead, that doesn't make a legitimate public company, in my view.
All right. And so, just to wrap things up, we were just in Toronto at PDAC earlier this month. And as you mentioned, there were quite a few companies represented there. So, did you see any interesting opportunities, especially within the junior space? And, where do you see these opportunities coming, the investment opportunities?
Yeah, I mean, I don't know if you want specific names. I mean, I'm happy to do that, but I don't know if that's what I mean, I think there's two areas I would look at among the juniors. One is the juniors that have some kind of business model that enables them to continue in business advancing without that constant dilution I talked about. So it could be a prospect generator where you get a partner to spend the money. It could be a small company with a royalty where they have royalty income that's going to last for 5 or 10 years and pays the bills. So there's examples of companies like that, and at least that doesn't guarantee you success by any means, but it does mean at least that the company doesn't have to keep diluting. I think the other area to look at, obviously, is companies that have the potential to make a worthwhile discovery. There is no question at all that the world is starved of worthwhile discoveries. That there simply aren't that many. And so everybody at PDAC, you heard it all the time. Every time you had a drink with anyone, it was always who's the next takeover, and we're going to get the takeover mania pretty soon. Well, we're not going to see seniors buying juniors unless they have worthwhile projects. And the truth is, the truth is that the number of worthwhile discoveries is very, very small. And so I think Newmont once said that 1 in 5,000 gold anomalies turns into a deposit in which they might be interested. Those are remarkably low odds, remarkably low. And so, with all the work that companies are doing, with all the money that they're raising, the result is just not an awful lot of good discoveries, unfortunately. But those discoveries are going to be snapped up at nice premiums.
Yeah, absolutely. And I guess, finally, any thoughts moving forward for the market? Do you see gold moving even higher? What should we be on the lookout for?
Well, no, that's interesting because, look, the reality is that I think gold is ahead of itself. It's overdue for a pause, if not a pullback. And in fact, a pause would be kind of healthy. I mean, if you look at the graph of gold, this year has been not quite exponential, but it's certainly moved well above trend of the last 2 years. Now, I've been saying that for a little while, I have to say, and every pullback in gold for 1 or 2 days is very, very quickly reversed. Gold is being remarkably resilient right now. So what I would say to people, particularly those who aren't in the market yet, look, just try to look past the next week or month or 3 months. Let's look ahead to where gold's going to be at the end of this year or next year. And it's going to be meaningfully higher in my mind. And so if you happen to invest tomorrow morning and gold happens to start its correction tomorrow, don't get too discouraged. You can't time it. The reasons that people have been buying gold over the last 2 years and increasingly over this year have not gone away. We still have, the desire of central banks to diversify away from the dollar. We still have weaponization of the dollar. We still have high debt everywhere you look, governments I'm talking about. Pretty much every government in the world has excessive debt. We still have inflation, that hasn't gone away. All of this is very positive for gold. And the new administration's policies are also positive for gold, the new US administration. When you live in the US, you seem to assume you become very US centric.
Mhm.
But the new US administration, all of those policies are very, very positive for gold.
Yeah, absolutely. Well, definitely a lot for us to be on the lookout for in this space. So keep watching and we'll keep catching up with you, Adrian, to hear your thoughts.
Yeah.
And we hope to, catch up with you at one of the one-to-one events soon, whether it's New York or London. But thank you for joining us today on the essay.
No, you're welcome. Thank you very much, Amy.